I want you to take a look at this graph I've displayed on your screen. It's actually very interesting. This is a mining stock, and it's climbed from about $1 in 2020 to on the verge of $55 now in 2026. Now that, of course, is a massive climb. It's really epic. In just the last 5 years, since 2021, its growth amounts to over 11,000%. That is explosive. I mean, for reference, Nvidia, which is often cited as an absolute beast in terms of price claims, Nvidia's climbed by only 1,400% in the last 5 years, compared to this stock's 11,000%. Now, that's mind blowing on its own. But the fact that this is a mining company, this is not some tech stock that blew up on the AI trend. This is a mining company. And more than the end result in this price chart, I want you to focus particularly on the path the stock took to get there. This rise is not some overnight price spike. It's actually a very systematic and a very structural climb. Now, normally in mining stocks, you can have some very volatile and very chaotic price charts. But this here, you don't see any collapses, you don't see any resets. What you see is climbs, consolidations, and then reclimbs. This is exactly what systematic compounding looks like. Now, what if I told you that there are actually very specific mental models that can be learned long before your price chart looks anything like this? In fact, you could actually use these principles as a checklist specifically to identify true wealth multipliers in the mining industry. And that's exactly what I'm going to try and break down in this video, so you can spot the next compounder before the rest of the market catches on, which obviously would be too late to go in on it. Now, for those interested, this price chart I've displayed, this is a $4.5 billion miner. It's called Aura Mining, and it trades on NASDAQ with the ticker AUGO. It has its operations in the Americas, and it primarily focuses on gold, zinc, and other base metals. Now, I want to reiterate that the principles and mental models I'm going to be discussing in this video, they're specific to mining companies and mining stocks. I mean, hopefully in the future, I'll probably make more videos about different industries and different trends. But everything I'm highlighting in this video is specific to mining. So the first thing you're going to want to look at is what I like to call macro regime check. Now, I know this sounds a bit complex, but what it basically means is you're going to ask yourself if the commodity price environment is structurally supportive right now and, not just temporarily strong. So this is the absolute first checkpoint you need to clear before moving forward, because you can't compound against the broader cycle in any case. It doesn't matter how good a company's financial discipline is, how strong its earnings are, and how robust its operations are. If the price environment isn't good, it's simply not going to perform. Or in other words, if the commodity regime is hostile, then none of the mental models we're going to discuss in this video, none of them will mean anything. So let's go back to our example of Aura Minerals. As impressive as this price climb on your screen is, the honest truth is that if the price environment wasn't favorable, we wouldn't really be seeing such an epic takeoff. In fact, in Aura's case, almost every layer of value creation that its management is talking about only works because the gold price regime is actually doing the heavy lifting first. I mean, look at it this way. If you're going to sell the same ounces of gold you sell every single year, but only this time it's in a meaningfully higher price environment, and your costs are largely fixed, of course, then you're obviously going to see your earnings climb substantially without doing anything different than you usually do. So that's obviously the very first check to look into. Is the price regime supportive or not? Now, I know what many of you are thinking. How do you tell if the price regime is supportive or not? Well, there are a few ways, of which I'll gloss over a few. First of all, you need to look at the top gold mining and equity indices. For example, you have the New York Stock Exchange ARCA Gold Bugs Index, which is a basket of unhedged gold stocks. Then you have the Philadelphia Gold and Silver Index. You have Van Eck Gold Miners ETF. These are just a few. What you could do is you could look at the performance of these indices over the last 6 months, or the last 3 months, or the last 12 months, and it'll give you a strong idea of where things stand in the industry. So that's the first thing you could do. Secondly, you could look at the all-in sustaining cost of the commodity, or the AISC. Now, this is a common metric in the mining industry, and it basically means the total cost per ounce to keep a mine operating sustainably. It includes things like operating expenses, sustaining capital, and all the ongoing overhead. So, for instance, let's focus on gold, for example. Based on gold mining companies, the average AISC right now is around $1,600 per ounce. In other words, that's how much it costs a gold miner to extract a single ounce of gold. Now, this information is easily available online. All you have to do is search for it. So, compared to an AISC of $1,600 per ounce, the current market price of gold is close to $4,600 right now, which points to a $3,000 gap. So, based on this alone, mining gold is very profitable for any company in this space right now. So, to sum up, the very first test to clear is the macro environment, and only if that is favorable, you go ahead and invest in the company. Now, obviously, having a strong macro regime on its own is not the only criteria you're going to look at, because this is not for macro tourists. This is a video for actual investors who are going to invest in actual mining companies. So yes, a strong pricing environment or a macro regime, it is necessary, but it's not sufficient in many times. Trust me, there are so many examples of gold miners that actually burn through value even in the strongest gold rushes. And at the same time, you'll find so many companies that are growing much more rapidly than the average player in the industry. Now, with that being said, let's move on to our second mental model, which is self-funding growth. Now, this basically means, as the name very much implies, that a company is able to finance its own expansion using the cash it is generating internally rather than, taking on debt or diluting itself by issuing shares. Obviously, this is important for every company, regardless of which industries it's operating in. However, for mining, this is especially critical. And now there are two reasons behind why self-funding growth is so important for mining. The first is that mining is an extremely capital-intensive business. I mean, we're not dealing with small amounts here. You require huge amounts of upfront capital. And the second reason is that we're going to be dealing with long development timelines. So your project isn't going to be monetized immediately. So with these two factors in mind, companies are typically increasingly drawn towards external capital. Not because that they are poorly managed, I must say, but because the industry's economics structurally push companies towards debt and dilution. So these are just the dynamics we're dealing with in this space. And that is why self-funders that break this pattern are so rare and valuable. And obviously, no company starts out this way. In fact, every mining company starts out as a capital consumer. But our job as investors is to identify those that have turned into or are clearly on a path to turn into a capital generator. Now, I know some who are watching this video might be thinking that by the time a mining company has turned into a capital generator, it's too late to invest. Well, the short answer to that is no. And thinking that way is actually one of the most expensive mistakes investors can make in mining. Let's just go back to Aura Minerals for a second. This right here is the point by which the company was fully self-funded. At this point, Aura's producing mines, which include Almas, Minosa, Aranzazu, have consistently been generating cash above what's needed to sustain its existing output and even fund new growth capex. In fact, and this is really cool by the way, Aura Minerals at this point was already paying out its shareholders with dividends and even buying back shares. So that's the opposite of diluting itself. In 2024, Aura Minerals mines generated close to $195 million in free cash flow, which was comfortably more than enough to pay for all of its capex. So look for capital generators because these are true compounders. Once they've got the self-growth flywheel going, any project they turn into is going to be far more likely to produce value for them than it is for those under heavy debt or dilution. And finally, the third mental model that investors should seriously prioritize is something called operational alpha. Now, this is basically the extra return a company generates, not as a result of its asset quality being any different to its peers, so much so, but through its operational excellence. I mean, look at it this way. You could have 10 mining companies working on projects that have the exact same grade of ore, similar reserves, and basically an identical exposure to gold prices. But despite all these similarities, it's actually very likely that only a handful of these companies would consistently deliver its projects on time, would not exceed its budget limits, would expand production efficiently, improve mine recovery, and even convert resources into reserves much faster than the rest. Now, that is a company that would be generating operational alpha. Now, why is this so important when it comes to mining specifically? Well, as I've already mentioned, the mining space, by its very nature, imposes tough financing dynamics on all participants. Businesses in this industry are immensely capital intensive, very cyclical, and have long durations before achieving monetization. In addition to that, most players are sort of dealt the same cards in the sense that they're dealing with similar commodity market prices, the infrastructure investments are usually consistent, and so are the technical methods of mining. With all that, however, the real differentiator is often how efficiently and skillfully a company executes its operations. Look, two mines may sit on equally rich deposits, but the company that consistently spends less per ounce mined, ramps up production faster, and avoids costly delays will generate far higher returns and value for its shareholders. A company with operational alpha can pretty much capture more value from the same resources than its peers can, and by doing so, it can fund growth internally without over-relying on debt or dilutive equity, which again goes back to the previous mental model I just discussed. So this makes a lot of sense, but the question, of course, is how exactly do we determine whether or not a company has this operational alpha? Well, there are a few things investors can look for. First, you need to see if the company has a track record of bringing projects online on schedule and within budget. We would ideally like to avoid companies that have a track record of running into delays and cost overruns. Next, you want to look at how efficiently the company produces its metal relative to its peers. You could look at metrics like all-in sustaining costs per ounce and compare it to the industry average. These sort of things give you a good idea of how efficient particular mining companies are at extracting the commodity from its mines. So these things help with turning average assets into extraordinary results. To wrap things up, I really hope this video was helpful for those of you looking at mining companies through a more thoughtful, long-term compounding lens. These mental models are some of the ways that can completely change how you evaluate businesses in different environments once you start seeing them through a different lens. So if you found this valuable, please consider subscribing. I've only just started doing this, and honestly, the level of interest and engagement will determine whether I continue making more videos like this. If there's demand, I'd love to expand this format into other industries, major trends, and maybe even specific stocks down the line. Who knows? So a lot of the ideas I share here are typically locked behind paywalls. I myself have contributed to such platforms in the past, but doing this here on YouTube is my way of making high quality investor thinking accessible for free. So if this resonated with you and you think it adds value, consider subscribing. It really does make a difference.